Okay, before we head in to this week's market outlook, keep in mind at 6 p.m. this evening, I have a live Q&A for the market update. We'll go live. This is when Globex opens as well. It is 6 p.m. New York time, or if you're in Canada, you think better in Toronto time, or if you just prefer Eastern time. I think everybody thinks better in New York time, but this is at 6 o'clock this evening, so just keep that in mind. Okay, let's go. Well, last week was an interesting week. It seemed all of the data came out in favor of the bulls. And on Friday, we had retail sales report that came in worse than the stated expectation, and bond yields rallied. They didn't drop anticipating that the Fed would cut rate. They rallied saying, oh, well, retail sales are weak. The Fed's going to keep rates higher for longer. And that didn't seem to make a lot of sense. So I will give you my best explanation for it. And to explain it, because we are in the equity markets all the time, to explain it, you must think like a pure bond investor. And once you think like a pure bond investor, the reaction to retail sales was probably more predictable than not. But again, you really got to change your mindset and stop thinking like an equity investor. We're going to start here with Governor Waller's speech that was given at 8:45 on Friday. Now, when he was giving the speech, he was already aware of the data that week. He was aware of the data the previous week on jobs. He was aware of both CPI and PPI. So we'll look at what he has to say. And I've highlighted some points, and I use different colors throughout here. There's the legend here. Some are interesting sentences. Some are holy shit sentences. So when you see green, that's, So let's see what we have here. And keep in mind, this was just Friday, 8:45, with in his head all the knowledge of all the data points that had come out. Relative to the Federal Open Market Committee's economic objectives, data for the first quarter indicate that economic output and employment are continuing to grow at a solid pace while inflation remains much too high. Again, this was said Friday after he had seen CPI and PPI. So even though they were friendly and bullish to the market in terms of, well, we must be near the end of the rate hiking cycle, his statement is it remains much too high. Based on what is already in the public record, SVB seems to have done a terrible job managing its risks. He spends some time talking about the banking issues that had shown up a few weeks ago, and dismisses them very quickly as, this really was just some bad risk management from a few banks that really should have known better. The BTFP and discount window, this is the special plan they put in place to add liquidity for banks by treating their security at par as opposed to the current market values. And the discount window appeared to have been successful in providing stability to the banking system. In the past few weeks, we have seen deposit flows stabilize across banks, and as a result, the combined usage of the discount window and the new program has moderated. Problem solved. This success allows us to focus on our macroeconomic objectives of price stability and maximum employment when setting the policy rate at our March FOMC meeting against this backdrop. These are the same words we saw in the minutes, against this backdrop. The FOMC raised the policy rate 25 basis points without causing significant stress to the financial system. To date, that decision has been validated. Let's just think about that. We raised rates, didn't cause any real problems, and to date, that has been validated. Nothing got worse. Look what we did. Everything's fine. It is important to note that there were indications of tightening credit conditions this year before the problems emerged in the banking system. In the board's January Senior Loan Officer Opinion Survey, bank officials reported higher interest rates for loans and tighter lending standards relative to the end of last year. These loan officers also said they expected to continue tightening lending standards over the course of 2023. They cited an expected deterioration in collateral value, a reduction in risk tolerance, and a deterioration in the credit quality of bank portfolios, which mirror the factors that contributed to the recent turmoil in banking. The failure of SVB and Signature Bank and related developments might have solidified and pulled forward factors that were already working to tighten lending conditions, or it may be that credit conditions will now be even tighter than they were on track to be. This is the concern, is that what we saw in the banking system might actually curtail credit. And if there's a pullback in credit, well, that could be bad for the economy. That's going to be important when we look at retail sales. Regarding the economic outlook, the data in hand for the first quarter of 2023 continue to surprise me. This is a Fed governor. Continue to surprise me with stronger growth and job creation than I expected late last year. The FOMC has significantly raised the target rate for the federal funds rate to dampen aggregate demand, but U.S. consumers and businesses are showing remarkable resilience. The Atlanta Fed's Gross Domestic Product Growth Tracker, which reflects the most up-to-date data, estimates that gross domestic product grew by 2.2% in the first quarter, in line with many private sector estimates and higher than most estimates of potential growth provided by FOMC participants. This growth would mean that, so far, tighter monetary policy and credit conditions are not doing much to restrain aggregate demand. Holy shit. Everything we've done, it's not doing anything, really. Now, does this sound like a Fed that's going to be concerned and wring their hands about going another 25 basis points? This guy doesn't seem like he's going to be too concerned about going another 25 basis points, because he said up here that we raised the policy rate 25 basis points without causing significant stress to the financial system. To date, that decision has been validated. So far, tighter monetary policy and credit conditions are not doing much to restrain aggregate demand. He's not going to quibble over another 25. You can mark him down for 25 because he's saying, listen, we raised 25, it did nothing, it didn't hurt the financial system, and honestly, even after all of this raising, 475 points later, it's not doing much. Look at GDP in the first quarter, 2.2. By the way, Atlanta Fed came out a few minutes later when it did the 2.2 and said, sorry, mistake, it was 2.5. It was 2.5. So if he was saying this sentence at 2.2, what's he saying at 2.5, right? Some data from March point to moderation. While still showing strong signs of growth, job creation did cool a bit from the hot readings we got in January and February. And he talks about inflation, they're seeing inflation coming down, which is welcome. So he does point to some things that are moderating. Now let's talk about what these developments mean for inflation. Inflation moderated in the second half of 2022, but that progress more or less stalled towards the end of the year, and inflation remains far above the FOMC's target of 2%. On April 12th, we got consumer price index inflation for March, and it was another month of mixed news. So he's seeing it as mixed. Core inflation, which strips out food and energy prices, is a good guide to future inflation, and that measure came in at around 0.4% in March, which translates to an annual rate of 4.6% if it were to persist. It was the fourth month in a row with core inflation at 0.4% or higher. Since December of 2021, core inflation has basically moved sideways with no apparent downward movement. I should have put that in green, but the next one. So despite some encouraging news on the slowing in housing costs, core inflation does not show much improvement and remains far above our 2% inflation target. I don't see any progress on inflation. Economy is a lot stronger than I thought. In fact, I'm surprised it's so resilient. We raised 25 basis points, didn't cause any financial stress. And listen, everything we've done to date doesn't seem to have caused anything to aggregate demand. This is somebody who is just not going to stop. Whether you measure inflation using the CPI or the Fed's preferred measure of personal consumption expenditures, it is still much too high, and so my job is not done. I interpret these data as indicating that we haven't made much progress on our inflation goal, which leaves me at about the same place on the economic outlook that I was at the last FOMC meeting. and on the same path for monetary policy. Because financial conditions have not significantly tightened, the labor market continues to be strong and quite tight, and inflation is far above target, so monetary policy needs to be tightened further. Another implication from my outlook and the slow progress lately is that, as of now, monetary policy will need to remain tight for a substantial period of time and longer than markets anticipate. And this was at 8:45. And somebody had asked me, why is the bond market behaving the way it's behaving? And I wasn't around for retail sales. I checked in later in the day. I was in the gym early and I was watching bank earnings, and I thought, well, that's it for the day. We're going to have a rally for the day on top of the rally we had, which was on top of the rally we had, which was on top of the rally we had. What's the point of me tormenting myself by watching a market move against me? So I checked in later in the day, and it was, in fact, down, and bond yields were higher. And I thought, well, I read Waller's speech. It had to be Waller's speech. But it actually came off of retail sales, which caused me to think a little deeply. And I thought, but why? So I had to think like a bond investor. And when I started thinking like a bond investor, I said, well, if I were a bond investor, what would I be looking at? What's my biggest thing? Well, it would be this guy here. How come it didn't did it leak before? So I had to really think it through. And I think I have an explanation for you. So I will explain, I think, the three scenarios that we're in right now and the positioning for those three scenarios and what the bond market reacted to. But let's begin our weekly update now that we have this sort of as a backdrop. All right, let's have a look at rates week over week. Notice on the 2-month and the 3-month, they both hit the highs of the year, or at least the highs of the cycle on April 14th in anticipation of 25 basis points for May, and we'll see what the probability there looks like. And all rates increased all the way through except the 1 month. And if we look at the bottom of the screen, money market funds increased by another 30 billion, now to 5.28 trillion for the week. Retail up by 8.1 billion, institutional up by 22.17 billion. And for the reverse repo, money can go into there, but there are position limits. There are limits for each counterparty that if you hit your limit, well, you have no choice. You got to go somewhere. And I think that's what's going on here in the 1 year, in the 1 month, is they're trying to take, I know on Interactive Brokers, when I look for treasuries, you can pick your days. There's some that are maturing in 3 days, 4 days, 5 days, 6 days. There's always some maturing somewhere, and you could buy those. So I think they took whatever they took, probably from the shortest term out to the longest term. Reason the shortest out to the longest is because maybe they can tomorrow flip that over into the reverse repo without hitting their position limits. Maybe, if we just go 1 day at a time, maybe we can find something, a place to put our money. So how this rate is determined is, let's take a timeline and say, well, 1 month. These are constant maturity yields, right? What if there is not a 30-day that's available that day? Well, they take securities in and around there, and they would extrapolate what that rate would be. So let's just draw a line out from the 1 month to the 2 month. There's the 1 month, and we can see that the 2 month is much higher at 498, and the 1 month is here. And that's probably being weighed down because everyone's loading in for as short as they can possibly get and moving out until all their money is in place, which when you extrapolate in and around the 1 month would make the 1 month appear to be very, very low. But the strategy is, well, I can't get into the reverse repo. Maybe I've hit my position limits. Let me grab the shortest dated T-bill I possibly can so that, it gives me time to see if I can't get into a 2 month or a 3 month or a 4 month, because there might be no supply the further out you go. So maybe they're piling into the front end as a temporary place to be, because this is counter to the probabilities for the FedWatch. It's saying going up 25, and this constant maturity 1 month does include the next Fed meeting within the next 30-day period. So it should actually be higher than the Fed funds rate, which is 4.83, and we're sitting at 4.29. And it must be because you got all of this stuff going on, and it's got to go somewhere. It's got to go somewhere, right? Let's have a look at the Fed balance sheet. It dropped 17 billion, and that was a pure drop in the balance sheet of 17 billion because the SOMA was unchanged week over week. Nothing matured in the SOMA, so the balance sheet dropped 17 billion. That means that banks have used 17 billion less from the discount window. Look at our curve inversions. The 2 to the 10, a capital market inversion, now 284 days. And the money market to capital market inversion, the more critical one, 172 days, and it deepened another 6 basis points from 156 to negative 162. The record for this inversion is 165. That happened on the Thursday of last week before the Friday. The 3-month 18 months forward minus the current 3-month is negative 187. Last week was negative 203. This is what has to happen to the forward curve at this point, is it does have to flatten. Right now you have a forward curve that looks like this. Huge inversion over here. This forward curve has to start doing this. This forward curve has to flatten out, and I'll explain my logic on the next screen. But this is moving in the right direction. Money markets, right? Just keep going up every single week, up to 5.28 trillion now. Okay, I've got this screen divided in two. We'll get to the bottom part after we finish the top. The bottom will be my explanation for what happened with retail sales. FOMC for May 3rd is now 17 days away. Let's have a look at the probabilities here. For no rate hike, it was 28.8. It's dropped to 16.6. 25 basis points, now sitting at 83.4% probability from 71.2. Never mind that. Come over to June. Look what's going on here. 5.5. 2 rate hikes. There's a 13.4% probability that will end at 5.5 in June 14th. So now 25 basis points is on the table for June as well. We had a 4.75 weighting last week, 0.6. Not much, but it was still there. That's gone. And the 5, meaning no change at all, dropped from 30% to 14. 5.251 hike, 69.7 to 72.7, but this weight jumped up to here, 13.4 on 5 well, it cascaded, if you know what I mean. But we now have some probability that you'll get 25 basis points in May, 25 basis points in June, 13.4. Effective federal funds rate sitting at 4.83, right in the middle of the target range. Reverse repo. And last week I had made a mistake. I used the April 6th reverse repo instead of the April 7th, which showed a very large drop, and it wasn't as large as it was last week. It was a slight drop, but it wasn't as large as it was. So I got the right number now. April 7th, 2.23 trillion is 2.253 trillion. The 239 to 253. That's an increase of 14 billion. That's going out at 4.8%, which is well above that 1-month T-bill rate that we saw at 4.27. Canadian CPI is in 2 days. This is an odd currency, isn't it? Over the last year, the Bank of Canada was raising rates at a clip a little faster than the U.S. Was doing, and it lost value. It moved 100 points at one meeting, and it lost value. The last 2 meetings, it decided, well, we're not raising rates, and it got stronger. This time it said, we're not raising rates, and it got stronger. I don't understand why the Canadian does the exact opposite of what it's supposed to do. So we got CPI coming in 2 days. If it comes in really hot, what the Canadian will sell off? And if it comes in really, really low, what, we're going to get stronger? I don't understand the Canadian and why it moves the way it moves, but there it is. Anyways, if you're following the Canadian, CPI is in 2 days. We have some Fed speak this week. Tuesday we have Bowman. Thursday, Waller and Bowman. Let's keep our eye on Waller because he had some hawkish things to say last time. Let's see what he says this week. And Friday we have Cook. I don't know who's going to be market moving or not. But let's think about retail sales for now and what happened. But we'll I'll explain this little drawing I have at the bottom. Currently, if we look at our forward curve, whether we're looking at 1 month forward rates or 3 month forward rates, they all look like this. They're all currently inverted. And our par curves are inverted, which is what we saw on the first screen. You have high money market rates followed by lower capital market rates. The 2 to the 10 is inverted. The 3 to the 10 is inverted. So we currently have inverted forward and par curves. If we think that inflation is the enemy, and inflation fight is not over, the Fed is going to raise rates. This will lead to a deeper inversion because the higher we go, the more likely the bond market is going to say, well, this is going to break something and cause a recession. And capital market rates will already be pricing in the recession. So you'll get a deeper inversion in the par curve. You'll get a deeper inversion in the 3 month to 10 year and the 2 to 10 year. And in the forward curve, the 1 month, the 3 month, or ZQ, whichever forward curve you're looking at, you'll get a deeper inversion. If, on the other hand, we think, well, the economy is falling apart, they're going to have to move and save the economy. Never mind inflation, the economy is falling apart. Then they will lower rates, and there is where you get your curve steepener. So here you're going to get a deeper inversion. Here you'll get a steepener. In both the par and the forward curves. If we were heading towards scenario 1 up here, you definitely want to be short beta and long duration. If we were heading to scenario 3 down here, you'd probably want to be long beta and also long duration because rates would be dropping. Here you're long duration because you're positioning for the eventual breaking of something, but you don't know when it's going to happen. As rates are dropping, you stay long duration and you move into beta because that's when you want to be in stocks, not when the Fed is raising rates, but when they're cutting rates. That's when the present value of those future cash flows begins to increase. What about in the middle? If you think, well, I don't know that we're going to be raising rates anymore, but the economy is saying there is no need to drop rates. And this is basically what Waller said is, look, if we're looking for the economy to tell us that we're done raising rates or that we need to lower rates, I'm not seeing it at all. It's not there. We're not lowering rates. And listen, they've been saying that for how long now? That they plan to keep rates high for an extended period of time. And the market just continually doesn't believe them, or at least capital markets have been pricing in a recession. And what we're seeing is that no, there is resilience out there, so rates are going to be higher for a longer period of time. And if that's the case, that forward curve is going to have to increase to represent the fact that the 1 month is not going to be cutting or that there isn't 200 basis points of cuts in the next 18 months. It's going to have to start to increase. So you're going to start to get a flat forward and a flat par curve steepeners on both of them. In this scenario number 2, markets will trade in ranges, and you'll want to be neutral on your beta and neutral on your duration. So you'll get sort of range trading. So you'd be net negative your beta here, then you'd be net positive, net negative, and you'd have some midpoint over which it's ranging. So for the S&P, if this is where we are higher for longer, I could see that you could range trade between 42 on the upper end down to maybe 39, 38.50 on the lower end. If this is where we are, and it's starting to look like this is possibly where we're going to be. So if this is a version of a soft landing, it's a soft landing at a perpetually higher level of capital, a higher cost to capital. So I just don't see any breakout much above 42. Okay, let's think about what happened to retail sales. Why would you get yields moving up, a bond sell-off with the retail sales that we got? Wouldn't it indicate that we are closer to a recession with the consumer falling off? Well, you got to think like a bond person. And what is a bond person concerned about more than anything else? Rates. Period. Nothing but rates. That's all that matters is rates. And you're looking at that government par curve, and what's the big deal? The Fed. Always the Fed. Where are rates going? Because that's all that matters. The Fed at the last meeting said, we're going 25. We don't know what the effect of this credit crisis is. if it is going to affect credit, well, first of all, let me back up. It wasn't a credit crisis. It was a liquidity crisis from some banks that had some poor risk management in place. I agree with that. It was not credit, it was liquidity. But they don't know if it's going to have an effect on credit. So let's just move 25 and let's just step back and see what happens. And Waller said, I'm not seeing anything. And retail sales said, we're not seeing anything either. Now you may think, but that's a ridiculous statement. It came in at negative 1%. The expectation was for negative 0.4. You got to look at the categories. If you look at some of those categories, they are typically purchased with credit, especially the autos, the new and used vehicles are typically purchased with credit. The big ticket items, furniture, appliances, things like that, and a lot of the clothing and going out to restaurants, hotels, are typically purchased with credit. Maybe they're paid off later on, but credit is used quite a lot, and this is retail sales, so services isn't in there. And we already saw that a lot of negative signs when we looked at CPI for goods. It came in at only 0.2. So there was some inflation in the goods producing, goods less food and energy, came in at 0.2, which is rather benign altogether. If there was an effect on credit, which is why the central bank only went 25, because they didn't know if there was or wasn't going to be, it would have shown up in retail sales because it is very credit dependent. And all we could muster was down 1%. That was it. That's all you could muster is down. Clearly, it isn't affecting credit. Clearly, it's not affecting credit because if it did, if there was the equivalent of a Fed hike in there, it should have been much lower than down 1%. It should have been much lower. If you strip out the autos, retail sales came in negative 0.3. That's it? That's all? Okay, well then it's not affecting credit availability, which means the Fed is going to look past that and they're going to go the other 25 because we were expecting, one to two more. And so the bond market said, okay, if credit isn't going to act like a rate hike, then there is going to be a rate hike, and that's all they care about for bond prices. So if there's only one rate hike and credit acts like a rate hike, that's not a rate hike. That does not affect the present value of bonds' cash flows. But if there are two rate hikes because credit isn't acting as one, that does affect the present value of bond cash flows. So a rate hike got priced in quite significantly, and the second rate hike is starting to show up as well, and that's why bonds sold off, because the belief was the Fed is holding back because they think there's going to be a credit issue. We saw from the banks this week, mind you, the larger banks, there is no credit issue as far as they're concerned. Loan growth came in, nothing to look at here, and retail sales did not drop significantly. Yes, it dropped, but everyone is expecting a drop. But because a lot of components in retail sales depend on credit, if credit was a problem, it should have been much worse, and it wasn't. So you look at this, if you're a bond trader and you're only concerned about the discount rate for the cash flows, all you're concerned about is the actual rate the Fed will move to. This increased the probability that no, they thought it would act as a rate cut. It doesn't appear to be acting as a rate cut. So we're going to have to step in and fill that gap. Go back to what Waller said. We raised 25 basis points, didn't seem to have an effect on the financial system at all. And of everything we've done so far, really hasn't shown much. Look at the economy. Look at jobs. GDP now is 2.2%. We're still creating jobs. Inflation is coming down. So really, we're not going to have to cut rates to save the economy at all. And he said, it's surprising even me. Rate hikes aren't doing much. The last 25 didn't do much. What's another 50 basis points going to do? Let's just be sure on the inflation thing. We go another 50. We don't seem to be breaking anything. We seem to be just fine. And that's what the bond market responded to, was that if this banking system did constrict credit, we should have seen a much more significant drop in the sectors that do rely more on credit, and we did not. So real rates all increased, and I've said before, real rates are more important in terms of the present value of future cash flows than nominal rates because it removes inflation. Revenues will increase with inflation. Nominal rates also increase with inflation, so real rates are cleaner. You have an inversion still from the 5-year to the 10-year on real rates. And break-evens moved around a little bit. Not much to talk about there. ZQ, Fed Funds Futures. Look what happened here. This is the current. Blue is what happened over Friday. I wanted to get this in. This was the gold line was Thursday's close, and this is what happened to Friday. And I said these curves have to flatten out, so this will have to keep dropping if we expect the economic conditions to stay as they are, where job growth is robust. Growth seems to be coming in above what the Fed anticipated, and inflation still is above the 2% target. Yes, it's coming down, but it's still above the 2% target, and the rate hikes really aren't doing much anyways. They're not cutting anytime soon. So when we look at December being 50 basis points lower, 2 cuts from where we are here, that has to disappear. You have to get a flat forward curve if we're going to stay between those 2 bounds that I drew out on the previous screen. Last week, we were bottoming at June at 95, implying 5%. Now this is being pushed to July at 5.06%. So higher, 5 to 5.6 for longer, June to July. And I think as each week goes by, if the data are going to keep landing in the zone that we're in, this is going to have to flatten out. December had some movement down as well, 4.565 from 4.445, 12 basis points higher, but still 50 basis points lower from July. And then going out to next March, we're 95.81, which is 4.19, which is 4.08 last week. Looking over 2024, December 3.07, last week was 2.77, so 30 basis points higher. And this December 4.39 versus 4.11, 28 basis points higher. That's an inversion of 132. We had 134. The week before was 130, then 97, then 78. This is going to have to move its way towards zero over time. It's going to have to get flatter. Let's look at TLT. What a terrible week for TLT, but what a good week for me, because I was looking, I remember I had closed my 102 puts and I was waiting for a nice entry into the May 104 puts, thinking that maybe TLT will pull back and give me an opportunity to get in. But it got really curious. The TLT was dropping on Friday, and I was watching the premiums on the 104s, and I'd check in the afternoon a couple of times. I'm thinking, why are these premiums not moving? And in fact, TLT is a little lower, and the premiums are less. What's going on? And so what I did here in blue at the bottom, because volatility, this is the volatility chart, it was so light you couldn't see it. I just traced it with blue. Look what happened to volatility every single day. This is Friday. You had this big drop in TLT and volatility dropped. Look at IVP, 0, 0, 0. In fact, it is the lowest of the year on TLT. But if you look at Treasury volatility on the 2-year is elevated, extremely elevated. So you got lots of volatility on the front end, very little volatility on the back end. The 30-year is elevated, but not so high. But TLT is like, nah, we're not interested. Last week was 62, dropped to 0 on the 13. That's the big one. Was in the 62nd percentile. Now it's 0. That means in the last 13 weeks, volatility has never been lower. Same with the last 26 weeks, same with the last 52 weeks. There was almost no premium in it. So I opened the 104, the May 104s, 100 of them this time. I sold 100 of them at 139. Because the premium just wasn't there. I should have been getting 170, 180 for these. Getting 139. So, it's not that profitable. The premiums just gotten tighter. Considering that TLT dropped 3.16% over the week, that we went from the 62nd percentile in IVP to 0, is a head scratcher. There's all sorts of head scratchers in these markets the last 6-7 months. Just things that you look at, you say, why? what am I missing here? You know, SPY eked out a small gain, 0.8%. So I do have, right now I have the 110 calls, which I'm long. I have the 115 calls, which I'm short, and they are now in the money by almost $1. But I'm not going to close them yet. But I will close them for some profit at some point, which is why I originally sold them. Was I was thinking, you know, as TLT increased, I thought, well, I can't really get any puts. I know what I'll do. I'll sell the calls because I expect it to drop. Well, now it is doing that, and this is now showing a profit. I sold 100 of these because I only have 60 of these. I want to add another 40, and I will add 40 when I close the 115s. I do expect some weakness in TLT over the coming week as the market digests data and says, yeah, the Fed does not need to run to protect the economy. The Fed is forecasting 0.4% real GDP, which means they're comfortable with 0.4% GDP. The Fed staff economists are projecting a slight recession, and they seem to be comfortable with that. So do we really think, with the economy creating jobs and industrial production down 0.5 and retail sales down 1%, that they're suddenly going to abandon the inflation fight and run and cut rates for those little tiny things? No. So I do expect more TLT weakness, which is fine. That will give the 115 calls time to earn money while I lose money here. And being that we have such low volatility, the premium has come out of these quite significantly as well. So between the two, I'm not, you know, as it keeps dropping, it's not like it's going to hurt me that much because these had higher volatility when I sold them. When I close the 115s, I will add 40 more to these, but I want to get them at a much lower price. I'm hoping to get them, you know, under $4 if I can. I can add 40 more there. I will keep these 100 open. I probably won't close these. I don't know if they'll be assigned or not, given that I do anticipate we'll have a flattening of the forward curve. I don't know if I'll be assigned these or not, but that is the game we play. We play uncertainty. So against that backdrop, we have OASs that have come in. The spreads, the credit spreads have decreased. However, you know, that is only up until the Thursday. We don't have a reflection from Friday on this one. The 1 to 3 year, I've added the extra panel up here. The 1 to 3 year IG is sitting at 5.14. The 1 year Treasury is sitting at 4.77. So there's 37 basis points from moving from default risk free to very low default risk, 37 basis points. And we can see the yields 514, 499, 497. You have some inversion up to about the 7 year, and then it increases after that. It's importing the yield curve inversion because if we look at the OAS, they're all upward sloping, right? 1 to 3, you have 101, 128, 143, 170, 175, 161. So the OAS curve is upward sloping. The Treasury curve is downward sloping, so the combination of the two has you know, some inversion with yields rising as you go further out, only because the OAS is upward sloping. Look at issuance from SIFMA. We do have the March data available now. This is March issuance. This is last March, so you can see 241 billion of investment grade. This year is only 102.9, less than 50%. 10.6 of high yield is now only 4.6, and 0.1 of convertible shows up over here. Year-to-date issuance, if you think January, February, March, is down 14.7% over the same period last year. Total outstanding sitting at 10.3 trillion, but we do have a drop-off in issuance from January and February. And again, if you look at March over March, really big difference there. With fewer issuances, I think that probably helps explain why spreads are so tight, is because if you are a credit investor, there's less supply available today. That will help support prices. This is agency debt. This is really curious, and I got a bit of a theory about what's going on here, because we do have a debt ceiling looming for the government. not the government agencies, but for the government. Year-to-date issuance. Isn't that odd? Up 200% year-to-date issuance. Look at this that happened in March. That is huge. Total outstanding 1.9 trillion. That is up 35% year over year. 35% year-to-date issuance up 200%. What's going on with U.S. agencies? U.S. agencies are companies or organizations owned by the government that are allowed to issue their own debt. What's going on here? Here is my thought, and I don't know. I'm just thinking out loud, and maybe somebody out there that knows a little bit more than me on this issue can correct me and say, that doesn't sound right. But you got a debt ceiling looming, but you have spending that needs to happen. So what if there was a line item for spending in the budget? Let's say line 56 for 400 million that had to be spent. Or let's make it a little bit more interesting. Let's make it 100 billion that has to be spent. Well, you can't spend it because you're at the debt ceiling. Can't issue new debt. You can only issue debt that rolls over existing debt, but you can't increase the amount of debt, but not the agencies. What if you said to one of the agencies, hey, this is now your purview. We're going to give you the responsibility over this. This is now your purview. So the agency can then issue $100 billion worth of bonds, and they are now responsible for that line item that would have been the responsibility of the federal government. Are they sending line items down to their agencies and getting their agencies to issue the debt instead? Because U.S. agency debt issuance up 35% year over year now. You may say, oh, but that could be mortgages, right? No, if you look at mortgage issuance, it is down significantly year over year. Up 35%. This up 200% year to date. And this. April will be interesting as we get closer to the debt ceiling. Our line items from the budget being passed down to agencies saying, let's make this under your purview now. This is your new responsibility. You go ahead and issue bonds and take care of this line item. We'll take it off of ours. It is now your responsibility. And when we raise the debt ceiling, we'll repay you this money. We'll just send you the funds for this so that you can then pay back the bonds. I don't know. I can't explain 200% year-to-date issuance over last year with total debt outstanding being up 35% in front of a debt ceiling in June where the government can't issue more debt, but you got the agencies going on a debt binge. I don't know. Anybody else out there have their eyebrows raised at this saying, well, that's an interesting story? Now, maybe somebody knows something and says, no. You know what this was? It was this over here. That's what's going on here. Well, then I'm an inquiring mind and I would like to know. Okay, housing from Freddie. This is as of the 13th here. This is as of Thursday, not Friday. The 30-year fixed rate mortgage dropped another basis point. And if we look at the 10-year U.S. Treasury, and here you have to look at it Thursday over Thursday, April 6th to April 13th was up 15 basis points. So this is up 15. This contracted 1, which means the spread has contracted 16 basis points. Next week in the housing market, National Association of Home Builders Housing Market Index, that's a diffusion index. It's been under 50 for quite some time. Building permits on Tuesday for March, and housing starts for March. And Thursday you get existing home sales. And the home builders, let's just go right to the home builders. Look at the week they had. DHI, D.R. Horton, and they report earnings this week as well, up 3%. Lennar up 3.25%. Toll Brothers 4.25%. Pulte 4.4%. KB Homes 3.76%. Hovnanian 4.26%. The Home Builder Index 4.58%, giving me no opportunity to add to my position. And with implied volatility dropping, the premiums are just undesirable on the puts. For the perceived risk, I think, of a pullback over the next couple of weeks. If earnings disappoint, I think they'll still be okay, but disappointingly okay. And if the forward curves begin to flatten and the par curves begin to flatten, if you get curve steepeners, You're going to have lower equity prices because cost of capital is increasing. I just can't sell puts at these low premiums, and the home builders, they know I want more. They know it. They know it. And they're not giving me any opportunity to get back in. Not happy with that. Mortgage apps up 5.3% for the week. Refis basically unchanged. It was like 0.006%. Everything done on the purchase index, 7.8%. Agency down 3.07%. Annually, basically flat. I'm looking to add more to agency, but I'm interested in anything under 950 at this point. I'm comfortable waiting. If there is a pullback in economic activity, if we do start seeing unemployment increase, if there is a credit crisis, any of those things, I will get a lower price on agency. And I am looking at the mortgage REITs for the rate cutting cycle that is eventually going to happen at some point. I just don't know when. And the yield is just fantastic on these. I can't pass up the yield. ABR, let me talk about ABR, because somebody hit me up in the comment section saying so-and-so said something on Twitter, and I'd never heard of this person before. Here's the thing about this industry. I want to say that there are hundreds, but it would be wrong. It would even be wrong to say there are thousands. It would even be wrong to say there are tens of thousands. Globally, there are literally hundreds of thousands of people with an opinion on Twitter, on TikTok, on YouTube. I'm not the only one that puts something up, on a weekly basis. Some people put stuff up on a daily basis, but if you search YouTube, you're going to find lots of this kind of stuff going on, where everybody has an opinion about something. I've never heard of this guy, but he says, oh, this guy says ABR is going down too. So I said, well, I don't know. Maybe you should sell them, because you're outsourcing your thinking to somebody else. I've done my analysis. I'm comfortable holding. Will ABR drop further? If you got any kind of credit problem, yeah, of course it will. That's the deal. But it has very good cash flow and a very good dividend yield and a very good history of pulling itself out of difficult situations. I'm good with it. I'm not moving. I like the yield. Down 5.3%, hitting 52-week lows. 98% of their loan book is multifamily and single family residential. It's not office, it's not retail. It's single family and multifamily. And I'm not bearish on multifamily units at all. I'm just not bullish. I've said this before. I've sold my apartment REITs not because I'm bearish, it's because I'm not bullish. I just don't know where the upside is going to come from. But I'm not bearish, not like office, not like retail. There, I'm significantly bearish. And I'll tell you what I did with the IYR in a few minutes, but I couldn't resist. I'm sorry, I couldn't. I said I wasn't going to play it, but I did. I couldn't resist. 98% of their loan book is multifamily and single family residential. In the middle of a housing shortage, where are you going to go? Where are you going to go? The cash flows from those buildings are more than going to take care of the interest costs on the debt. I'm unconcerned. I'm really unconcerned. Their last dollar loan to value ratio, 76%. What does this mean? It means the property values would have to fall to 76% of their current value before they'd start to absorb a loss. I just don't see that happening. If we look at Canada, for example, if you are in the housing sector in Canada, you couldn't miss I don't know what bank put this out. There's a report last week saying that housing prices have probably bottomed and are more likely to be higher by the end of the year. And I kind of believe that, given the level of immigration that we're targeting and the shortage of housing we have. Where do we think prices can go? These people who were calling for 20-30% housing crash, how? It doesn't make sense. If they don't exist and you have people coming in, how is it possible that you're going to get this crap? Where's it going to come from? What, people going to leave their homes and head to apartments that have 99% occupancy? Not going to happen. So I just don't see it happening in that sector. Now, office, yeah, I can see it happening in the office sector. I can see it happening in retail. But I just don't see it happening in multifamily and single family residential. I don't see that at all. 24% drop in price before they start absorbing the loss, I am good. If this is doing anything, it is just giving me an opportunity to buy at lower prices. If you want to outsource your thinking to somebody on Twitter who has, basically, I had to look him up because I said, who is this guy? He seems to have this pattern of just bad-mouthing other people and saying things. And I get what he's doing. You're building an audience. I shouldn't have drawn it this way, should I? I just noticed something here. Let me just do some extra drawing over here to change that. Listen, if I needed to build an audience really quick, the best way for me to build an audience is go negative. That is the best way for me to build an audience, because I'll see this person over here that has an audience of 3 million, and I'll say, how do I get that 3 million to look at me? I know, I'll call this guy out. I will call him out and call him out and call him out until he responds to me. And when he responds to me, his 3 million people now know me. And it seems like this person is building an audience by just going negative, and that's fine. I mean, if that's that's a strategy if you want to build an audience. But if you're outsourcing your thinking to somebody else, you're not going to know when their thinking is changed. You're not even going to know what their strategy is. Is their strategy? Are they doing what they're doing because they're imparting knowledge to you and sharing knowledge? Or are they doing what they're doing to build an audience for their own benefit? And you're just somebody they're using to get that done with. Be careful about outsourcing your thinking. Listen to what other people have to say, but then do your own thinking. Do, as they say in the pandemic, do your own research. But this is something you can do your own research on, right? Be careful. Let's look at, I'll tell you IYR in a minute here. Look at MBS. As I said on the other screen, we were concerned about agency debt accelerating at the rate that it's accelerating at, which is a head scratcher. And you think, oh, well, it's got to be the mortgage market, right? Maybe it's Freddie and Fannie. Issuance year to date down 65%. If issuance year to date is down 65%, how is it possible that you can have 200% year over year? You got to think about, well, how much more is it of other things to overcome the fact that this is down 65% year over year? Total outstanding, 12.2 trillion here. And we did have a slight increase going into March, from February to March. After how many months of decline? You had a slight little increase. So we had agency, 76.6 billion over here. This here is agency CMOs, collateralized mortgage obligations, and you had no residential mortgage-backed securities. These are non-agency mortgage-backed securities, and then commercial mortgage-backed securities increased a bit, 0.9. So we can't look to this to explain what was going on with agency debt. I have no explanation for why it has grown 35% year over year, why it's up 200% for the first 3 months. But combine that with a debt ceiling and a willingness to spend money, I think they're moving line items off their budget into the budget of these agencies and saying, you issue the debt and you do the spending now. Okay, let's have a look at CPI. We can go down to, there's all items over here. March 0.1 looks kind of nice, right? All items less food and energy, 0.4. And we can see this is seasonally adjusted from September through to March. And while I'm on the seasonally adjusted thing, I think there's some big problems with seasonal adjustments. I mean, when we look at retail sales, just the month-to-month volatility in retail sales, I do think there's some serious seasonality issues, because if you are changing your seasonality factors every 5 years, let's say, well, you've got 3 regimes in there. You got the pre-pandemic regime, you got the pandemic regime, and the post-pandemic regime, with all sorts of big changes throughout all of those. That, going from pre-pandemic to pandemic had big changes, from pandemic to post-pandemic had big changes. That the seasonality's got to be off. So I'm skeptical with all the seasonally adjusted figures these days. Now, using the unadjusted numbers, yeah, you've got some seasonal effects in there that might make it look like something is going on, but I seem to think the unseasonally adjusted numbers might be a little bit clearer than the seasonally adjusted numbers now. But anyway, seasonally adjusted changes from the preceding month. Look at all items less food and energy from September. 0.6, 0.3, 0.3, 0.4, 0.4, 0.5, 0.4. That doesn't look like much. You had 0.2, 0.3s back here. Then you went up to 4, 4, 5, 4. Again, seasonally adjusted, right? Let's just go down to the unadjusted indexes, because that's what I used to do a few of the calculations to see what we have. Services, let's go down to services less energy services, and I just used the unadjusted index, 6.1% annualized basis. It is a 0.5, and if we look at the seasonal adjustment, it's saying 0.4. Last month was 0.6, so you got a 0.5, a 0.5, a 0.6, a 0.4. But using the unadjusted indexes, you get 6.1% annualized. Shelter, 8.2% annualized on shelter. If you just look at the month over month, 8.2% annualized. So being that we have the weightings and we have what the annualization is, we could solve for the unknown and say, well, what would services less shelter be? And it comes in at 3.04% annualized, again using the unadjusted indexes. So 3.04, you can't quibble on that one, say, well, it's still too high. Yeah, it's coming down. Waller said, yeah, we do see some moderation, but it still remains much too high. But shelter is a large component in CPI. It is a much smaller component in PCE, and they pay attention to PCE, so we're going to have to look at that. The housing sector, we do have a shortage of housing, and that is what's keeping prices elevated. And based on this last report out of Canada, they expect prices that this is the bottom in pricing. And I got to tell you, it's been a pretty pathetic pullback. If this was the pullback, it's been a pretty pathetic pullback. That prices will move up from here. And if we start seeing that in the US, where prices start moving back up again, if housing prices start moving back up again, rents will follow along, because what's your alternative? A tent on the street? That's your alternative, right? So rents will follow along as well. That the Fed, in looking at core services ex housing, is saying, well, housing will continue to come down. Well, will it? Mortgage applications are showing that it really doesn't care about mortgage rates in the 6%, because 5 of the last 6 weeks have shown mortgage applications increasing, not decreasing. Look at the home builders and the home building sector on fire. I mean, I think it's been one of the best performing sectors this year. In terms of traditional sectors, it's just been incredible. I don't think it is unrealistic to suggest that if employment remains strong as it is, and there's visibility on rates, meaning, yeah, here's where rates are going to be. Mortgage rates will be 6.2%, but they'll be 6.2% for the next couple of years. As long as you have visibility and predictability, as long as uncertainty disappears, you could have an expansion of the housing sector even at these mortgage rates. So the idea that, well, housing will just come down gradually on its own, I don't know. What if it just turns around and goes back up again, right? I don't think that I'd be the only one thinking that. Let's look at PPI. PPI is rather interesting here, and we're going right to March at the very bottom of the screen. This is services for intermediate demand, all negative, which is, this is the input before it goes out to the consumer. This is the producer. These are prices received. CPI is prices paid. This is prices received. So prices received for final demand. I think we have it up here. Yeah, processed goods for intermediate demand, unprocessed goods for intermediate demand. Look at March, all negative along here. I think the more interesting one, the stages of production. Stage 1 feeds into stage 2 and stage 3. Stage 4 is for final demand. And you look at March, they're all negative as well. Well, that would be consistent if you had a story of dropping demand from producers. So we are seeing retail sales that are negative for the month of March, although the seasonality thing, this is all seasonally adjusted as well, right? So I think there's some issues with the seasonal adjustment, but this is what we have to work with. You have Retail sales that were negative for March, which showing potentially a drop in demand from the consumer. Well, that filters through the businesses. Businesses will anticipate that sooner and will adjust their demand sooner. So if there is a drop in prices because of a drop in demand, PPI would show that before CPI would show that. And we did see in Q4 GDP that there was an inventory build. So perhaps there is a working off of inventories right now and bringing inventories down. If you're bringing inventories down and working that off, you don't need to build new inventories, which means your ordering is lighter, and that could put downward pressure on input prices that are captured by producer price indexes, put downward pressure on those prices because of a drop in demand, not necessarily because supply has come back online, it's robust, everything is fine, competition is coming in, and everyone's fighting for business again. It could just reflect a drop in demand from producers. But still, that's what higher interest rates are meant to do, is to bring back aggregate demand so that prices can come back in line. If we accept that argument, it's not showing up in unemployment yet. It's not showing up in the initial claims. Now you could say, well, initial claims are elevated around 225, 226, being from under 2. But we looked at that last week. Because of the way they changed their adjustment factor, there were some periods where the older data was better, and the older data was worse. No, the older data was better. No, the older data was... So it oscillates between better and worse, that on average, I don't think it really counts for very much, but we're not really seeing it in job growth. We should see losses of jobs. But the unemployment rate sitting at 3.5, I don't know. So even though this is a promising sign, I don't know so much that I would say, well, this is it. This is the way down. Not unless unemployment starts increasing, because if national incomes stay where they are, that means potential demand is where it is. It's not changing. And if you keep adding more jobs, even if wages are increasing only at 3 and 3.5% where the Fed wants, more jobs at 3 to 3.5% more each year means more potential spending that can happen in the economy. That it could be we're working down inventories right now, and once inventories are down, if employment doesn't fall off a cliff, these producers are going to have to rebuild inventory again. If they got to rebuild, well, that could push prices up even further, and I don't think that I'm the only person who would think that. I think in that FOMC room there are probably other people saying we can't take the chance that this will happen. You got inflation on the ropes. Now's not the time to back up into the middle of the ring. Now's the time to lean on it while they're on the ropes. You never let somebody off the ropes. For those of you who have ever done any boxing before, when you get them on the ropes and they're doing nothing but defending, you don't back off. You never step back into the middle of the ring and say, okay, I think the job is done. You finish it on the ropes. I don't think that they're going to let inflation off the ropes at this point. Inflation is not knocked out. It's just on the ropes defending itself, but it's not knocked out. I don't think they're going to do that, because there is the very real possibility that housing prices could start moving back up. There is the very real possibility that demand holds up, that employment holds up, and this inventory drawdown will have to be rebuilt in the months coming up. So this idea that inflation will only go in one direction at this point, I think might be a little bit premature. All right, let's get right to SPX. I'm leaving out currencies and metals this week because I don't know that there's much interesting that has happened there. Gold did what gold is supposed to do when interest rates go up. Gold went down. And over the last couple of weeks, copper again has outperformed gold. So everything seems to be in line. The yen weakened, the Canadian weakened on Friday after strengthening. But nothing exciting, really exciting there. This has me, confused again. Let's look at where we are in the market. Our forward 4-quarter earnings, 224.40. You may say, wait, it was 217 last week. We're already in Q1, so that falls off, and we add Q1 of 2024. And earnings did look like this each quarter. That is a normal projection. No one ever says, well, we'll go up and then we'll hit a recession, then we'll go. Analysts don't do that. They just forecast linearly. So we're adding Q1 of 2024, and Q1 of 2023 has now dropped off the forward earnings, so that's why it has a bump up, because the $50 number is gone and we've added the $57 number for the quarter, so we're up. Closing SPX 41.37, that puts us at 18.43 times the forward earnings from where we are now. If we use a 16.6 times multiple on the 224, we get the 37.2504, and since this is a reflection of the price index instead of a long-term return on SPY of 11%, considering that the dividend yield is about 1.8%, that means price returns about 9.2. A 12-month target would be 406.774. That would be for this time next year, a 12-month target 406.7. We're sitting at 41.37. This is equilibrium pricing. If we assume equilibrium pricing, basically you would be higher than equilibrium if you said no, the market deserves a higher multiple. We'll be in a higher growth period than what a long-term average would be. Or that our earnings are going to be higher than what they are, but they've only come down. We've had Q4 of 2022 negative earnings growth, and if Q1 comes in negative as anticipated, you are in an earnings recession. And the earnings recession usually precedes the recession, because that's where companies start saying we need to cut more. And when you cut, you're cutting somebody else's income. And when you cut somebody else's income, you cut demand. When you cut demand, it circles back to the organization that says our revenues are dropping, we're going to need to cut. The inverse of this is 5.43. The 10-year sitting at 3.52. So you got a risk premium sitting there of 191 basis points, as opposed to a 400 to 500 basis point risk premium that you would expect. The 6 month is sitting at 5.03. So if you think that, well, we're at 41.37, I think over the next 6 months I'll get a better return out of SPX than I will out of a 6 month Treasury. Then off you go, right? This is bothering me. Zero. Look at implied volatility, under 15%, 14.795%. So I've got a little bit of a theory here of what it could be. I've said before that I don't think 0 days to expiration options are doing anything, because they're simply not counted. You need at least 17 days before the expiration of an option to be counted in the calculation for implied volatility. So if you have options that are 15 days to expiration, they're not even counted in this calculation, because you need an average of 30 days. And once you get to 17 days on the front month, you start using the second month contract to calculate what a constant 30-day implied volatility is. So zero's not even counted. But it didn't. Something occurred to me on Friday that didn't occur to me before. Is you have 0 day to expiration options where the volume has increased significantly. So you end up with a lot of intraday volatility, but not a lot of implied volatility over the next 30 days, which seems rather odd. Well, what if you had volume in this category, for whatever options they look at to get implied volatility, and the 0 day to expiration lowered the amount of volume in this category? Well, then that would lower the amount of buying and selling. Well, mostly buying, because your dealers are on the other side. Most options are purchased. So that would lower the demand for calls and puts that are further dated, because it's all being brought forward. And if that lowers the demand, well, then that has less upward pressure on price. And when prices go up, since all the other components are fixed, it's implied volatility that absorbs that, and implied volatility appears to be higher. That the implied volatility based on option pricing is higher because the price is higher, but nothing else has changed. If you reduce the demand, perhaps that's reducing the premiums. And if you reduce the premiums, since everything is fixed, well, it must be implied volatility's fault. Because it seems odd to me that we would be hitting such lows. Same with TLT, 0% across the board. Implied volatility here, almost nothing. There's almost no premium at all. Could it be this? Now, I could have dug a little bit deeper and looked at a volume history over a period of time for certain options, but I just didn't want to get into a 6 to 7 hour exercise for that. So there's a thought. Somebody out there who needs to write a paper, there you go. Does 0 day to expiration options have an effect on implied volatility by taking volume away and thereby taking price pressure away from options that are used to calculate implied volatility? And if it is, then the VIX is broken. If that is the case, then the VIX is broken and it's no longer a valid signal. So there's a conclusion right there. There is something important to know. Is that having an effect? So here's where I stand with the index here. I told you that I sold the 4170 calls last week. And I got 124.50 for them. I did cover at 114.50, 10 points lower. And then I put them back on again at 126, and I did cover at 116, 10 points lower. The next time I sold them at 130, and I covered at 117, 13 points lower. And late on Friday, I got them again at 132. And I thought, well, if there's going to be a lot of intraday volatility because of 0 day to expiration options, but very low long-term volatility, I'll day trade the bloody options. I don't care, but I'm not buying 0 day to expiration options, but I will treat them as 0 day to expiration options and just look for 10 to 12 points every single day. Why not do that? So now I have the 132s. Except I have increased the number that I use each time. So I was able to add a significant amount of profit last week just from trading in and out of these. I think, and this is where I am right now, I am net short beta, and I'm still net long duration. But I think that as the market begins to move downward, which I think it probably will, I think it's capped on the bottom. I don't know that unless we get something falling apart, I don't know that we're revisiting the October lows. I think we're range bound for a while, that when you start pushing 41, almost 41.50, getting to 42, I think more people will become uncomfortable with the pricing in the market. But once you start getting back to 3,900, 3,950, I think people will feel comfortable getting back in, because I think the rate hiking cycle is probably closer to the end than not, but the economy is showing no signs that it needs lower interest rates. So you're going to have a central bank that is working for Main Street, not for Wall Street. So we're left to our own devices at this point. They're not going to come and save us for small little things. Something has to be falling apart for them to come and save us. And listen, Powell always believed that the zero line was temporary. He never believed that that was the home. He always believed that was temporary and that rates should be somewhere around the 2.5. So even if rates were going to be cut, they're not going back to 2.5, which means you need a higher cost of capital. That has to be factored in, and the equity market hasn't got it. So when we're looking at the price of a stock, and I'm just going to do this rather quickly, you have your cash flows in your numerator, and you have your discount rates in your denominator, right? Bond market is focused on this. There's the bond market right there. And the bond market on Friday seems to have been doing its job. Equity market seems to be focused on this. And looking at cash flows. And it seems that that is the disconnect between the bond market and the equity market, is that, they have to come into alignment at some point. So that if the bond market is right, and I think the bond market is probably the smarter market because it really only has to pay attention to rates. It really is focusing on one thing, cash flows have been coming down, and this rate has been going up, that even if you think, well, cash flows can go sideways, if your denominator, as the bond market is suggesting, is going to be higher for longer, and if you start getting a flattening of that forward curve, you're going to have to start raising the cost of capital, the weighted average cost of capital, which is your denominator, which is going to make each dollar of cash flow less valuable today. that given a higher cost of capital, 18.43 is just the wrong multiple. A 5.43% yield is simply just the wrong earnings yield given a higher cost of capital. So on that basis alone, I can still feel comfortable being net short beta, even though I probably think neutral is the better place to be. And I think I was perfectly willing to hold my short position until we got to 37, 36, 35, but I think I'll probably move more towards beta neutral as we start moving closer to 390, and at 390 I'd probably be as neutral as I could. At 380 or 3800 I'd probably start being net long on beta. If the economy is still doing what it's doing, and we don't see really any problems on the horizon, then yeah, that's probably what I'd be doing. So I'm not changing my mind, but I'm shifting the boundaries under which I would be net long versus net short. And that's it for the week. Remember, the reason I'm cutting it short, at 6 o'clock, which is in a few hours here, 6 o'clock, I have a live Q&A for the market outlook. So anything I didn't cover there that you feel that you have questions about, you can hit me up there. But with everything I have to do today, I do have to cut some things short, and this is one of them. Actually, we'll look at the week ahead economic calendar, and then we'll look at earnings, and we'll wrap it up there. Okay, for our earnings, we won't bother with the economic calendar. There really isn't much. I told you what to expect for housing. I told you when Fed speak was, and Tuesday is Canadian CPI. Other than that, the reports are not that important. I think the big thing this week are going to be earnings, and especially right here, regional banks. I think there's 8 or 9 regional banks that are reporting this week. You got a couple more here, 1, 2, 3, 4, some more down here as well. There's another one there. So pay attention to those. Other ones of note this week, you got financials leading off the week. Bank of America, Bank of New York, Goldman Sachs. On Wednesday, you have, where are they? I keep losing them, and I know they exist here. Oh, sorry, there it is, Wednesday. There is Tesla. That will be interesting to see. D.R. Horton is reporting this week as well. There they are on Thursday. You got more banks. These are regional banks down here. Freeport, let's see what they have to say. And Pool Corporation, they're in the home building ETF as well. So if you're interested in that sector, they're there. And we'll leave it at that. You can access this off the S&P Global spreadsheet. I haven't been able to find the most recent one. Maybe they've gone to updating it bi-weekly instead of weekly. I don't know. I haven't found the most recent one. So the EPS that I've used are basically from April 6th. I don't have an April 13th update. And that's it.